All right, good morning, everyone. My name is Sharon Lagenza, and I'm the Executive Director of Housing Action Illinois. The Housing Action Illinois co-leads the Illinois CRA Coalition along with the Woodstock Institute, which is up here. So first I want to welcome everyone to our event today. We're going to be talking about the Illinois Community Reinvestment Act. So for the first part of this, we're going to be talking to you a little bit about what this new state law does and how groups can engage with it. But then afterwards, we're going to spend a lot of time actually networking with each other, because the whole goal of this is to build relationships to drive investment into communities throughout Illinois. So this is our third roundtable. We had our first one in Fairview Heights, which is in the Metro East St. Louis region. Then we had one in Springfield, Illinois, and now here is our Chicago one. So before we actually get started, I wanted to ask the people in the room a little bit, so who here is from a not-for-profit community-based organization? All right. Who's here from a government agency or representing a government agency? Who's here from philanthropy? Okay. Who's here from a bank? A credit union? And okay, raise your hand proudly. And who's here from a mortgage company? Okay. So welcome everyone, and we do that just so you get a sense of the breadth of the organizations and entities represented in this room. And so afterwards, you'll have a chance to connect with each other. So the Illinois CRA Coalition came together quite a few years ago now. I don't even want to put a date on it, really to look at federal CRA rule changes. And at this, then about 5 years ago, the opportunity came up to create a state CRA. And we kind of got together, we did a lot of comment letters, a lot of advocacy, and we formed what we call the Illinois CRA Coalition. You can find out more information about the coalition by going to IL-CRA-coalition.org. And in that, you can find not just what we're currently doing, but a long list of all of the comment letters we did, webinars, and other educational activities throughout both the federal rulemaking process and also the state CRA rulemaking process. So that's kind of like looking backwards. Now, last year, the rules were finalized for the state law, and you'll hear more about that. But we want to look forward. Now is a chance to build relationships and to make sure that the state law works the way that it's meant to, and that, you know, despite what might be happening on a federal level, that on a state level, communities throughout Illinois can thrive. And so that's the purpose. So I'm going to get off the stage soon, but I want to introduce the two people who are going to be kind of shepherding the webinar next is Jane Doyle, who is actually now the interim policy director for the Woodstock Institute, and my colleague, James Miller, who is a capacity building associate. So James? Is it James?
All right, good morning, everybody.
Good morning.
So I'm going to start our conversation today with just a brief background on the Illinois CRA, just for anybody in the room who's not quite as familiar with the contents and the history of the law. So the Illinois CRA was signed into law by Governor Pritzker in 2021, and the final rules were adopted last May, as Sharon mentioned. The law was passed as part of the Illinois Legislative Black Caucus's policy agenda under their economic access, equity, and opportunity pillar. It was intended to supplement the federal CRA by building out a state regulatory framework to address the consequences of redlining. To that effect, the Illinois CRA acts as a tool to ensure that covered entities, which are state-chartered banks, state-chartered credit unions, and state-licensed mortgage companies, invest and conduct business in Illinois communities in a just and equitable manner. The Illinois CRA requires those covered entities to meet the financial needs of the communities they serve, with a focus on providing access to credit for low and moderate income neighborhoods. The law made Illinois the second state with an oversight system covering the three major segments of the mortgage lending market, which are those banks, credit unions, and mortgage companies. And while the banks were previously subject to oversight under the federal CRA, the Illinois CRA created a new CRA obligation for credit unions and mortgage companies. Under the law, the Illinois Department of Financial and Professional Regulation, IDFPR will assess how well each covered entity fulfills its obligation to provide accessible and responsible financial products and services to the communities they serve and adjust in communities they serve. Based on those assessments, IDFPR will assign each entity a rating that is used to evaluate its applications for activities within the state, which include relocations, mergers, consolidations, acquisitions, assumptions of liabilities, and in the case of mortgage companies, renewals of their license to conduct business within the state of Illinois. Now, I'm going to pass things over to Jane, who's going to get a little bit more in depth on exactly what it is IDFPR will be assessing as part of their examination process.
All right, getting into the nitty-gritty. Good morning, everybody. So I'm going to go through a little bit about the exam process. First, start off with a discussion of what community development is exactly, and then pass it back to James for assessment areas and to talk about the comment process. So first, community development. At the federal level and at the state level, the CRA revolves around community development activity, but that's a pretty broad umbrella. So you can think about it in terms of 4 different buckets to kind of categorize community development activity. 1, affordable housing. This is often what people think of. Financing affordable housing developments, affordable mortgages, along that vein. 2nd, economic development and small business, supporting small businesses in low and moderate income communities. And 3rd, stabilizing and revitalizing low and moderate income communities. So that, I like to think of this as ensuring that low and moderate income communities have access to the basic amenities and community services that they need to thrive. Think grocery stores, child care centers, pharmacies, those kinds of basic amenities. And 4th, social services for low and moderate income individuals and communities. This piece often comes through partnerships with nonprofits that are serving low and moderate income communities. And then there's kind of a 5th bucket, optional and only as it applies, that's disaster recovery and remediation efforts, but that only applies when it applies. So overall, community development activities are oriented towards ensuring that low and moderate income communities' banking, credit, housing services are being met, and their needs are being met in those areas. A few more specific examples. Community development can be investing in a community development financial institution, or CDFI's loan pool, either on the mortgage side or on the small business side. Financing a housing development that uses low-income housing tax credit as part of the capital stack. Supporting supportive housing developments and organizations. Offering a special purpose credit program, which are loan products that are specifically designed to meet the needs of underserved communities. And that's authorized by the Equal Credit Opportunity Act at the federal level, and can be on the mortgage or small business side of things. Also wanted to mention offering a bank-on account or a bank-on equivalent, which are bank accounts that are geared towards bringing unbanked and underbanked consumers back into the financial mainstream, so they have more affordable account features, low annual fees, no account minimum, that kind of thing. And that's a national designation, bank-on. Also making a grant or investment in a nonprofit that serves low and moderate income communities. And then finally, one thing that I wanted to make sure to mention is larger institutions can provide, for the Illinois CRA specifically, larger institutions can provide material support for small credit unions and minority depository institutions, or MDIs. That came out through the rulemaking process that we engaged in with the covered entities and IDFPR, but by virtue of the kinds of financial institutions that they are, small credit unions and MDIs are often already meeting the kinds of consumers that CRA activity is really geared towards serving. So larger institutions can support them to reach those consumers as well. All right, and the exam process. This gets a little technical. I'm gonna try to keep it a little exciting-ish. That might be ambitious. I don't think you want that. So the exam process. IDFPR has started implementing the Illinois CRA by examining institutions. They just started that this year. So the first couple of exams started in February, and they post the exam schedules quarterly, 30 days before the beginning of the quarter. So actually the exams for the second quarter of this year were just posted at the beginning of March. So you can see what institutions have their exams coming up in the next quarter. There are 3 tests in the exam process: the lending test, service test, and investment test. And I'll go through those in a little bit more detail in just a moment. But there are specialized exam procedures for the smaller financial institutions. I'm not going to get into all the details there, but it's important to keep in mind that the most comprehensive CRA exams at both the state and the federal level are going to go towards the largest financial institutions. Smaller institutions have a little bit lighter requirements. The exam results will be made publicly available, and for those who are already familiar with the federal CRA, these will look very familiar. Outstanding and satisfactory are considered passing ratings, and then needs to improve and substantial noncompliance are considered not passing ratings. And as Rob mentioned, those ratings can have an impact on a financial institution's ability to open a branch, relocate, those kinds of things that require regulatory approval. A not passing rating, needs to improve, or substantial noncompliance will also result in a shorter timeline for the next exam cycle to occur. Regulators want to make sure that they get in there, make sure that anything that led to that not passing rating is being addressed, so sooner rather than later. All right, first up, the lending test. This one is the most quantitative and the most specific in terms of what it considers, so this is the wordiest slide of the 3. Please forgive me for that. All 3 types of entities receive this test: banks, credit unions, and mortgage companies. And the lending test evaluates the financial institution's mortgage lending, small business lending, small farm lending, and community development lending. And then there's another optional consumer lending, sometimes if it's a major business line for the financial institution. This test will also look at just originations and the first purchase of loans. This was something that also came out through the rulemaking process. At the federal level, we've seen a problem that is known as loan churn, where one mortgage will appear on the originating bank's CRA exam, then it gets sold to another bank and appears on theirs, then it gets sold to another, and down the line. So over the course of a 30-year mortgage's lifespan, it can appear on multiple CRA exams, but it's not really creating the new and ongoing investment in the community that we want to see through the CRA. So that's why the focus on originations and first purchases, to make sure that institutions still have the liquidity to be able to originate new loans, but that we're not getting that loan churn and having one loan be recycled into multiple CRA exams. The lending test will look at loans in a couple of different ways. It'll look at the geographic distribution for mortgage and small business / small farm, and it'll look at the dollar amount and the number of loans by the income level of different geographies. So it'll look at how much and how many loans went to low-income census tracts, moderate-income census tracts, high income, and how does that compare to the actual distribution of those census tracts in the institution's assessment area, which again, James will get to in just a minute. It will also look at the borrower characteristics for these loans. So for mortgages and consumer loans, they'll look at the income level of the borrowers. Again, how many and how much of the lending went to low-income consumers, moderate income, high income, how does that compare to the actual population of the area? And then for small business and small farm loans, it will look at loans made to small businesses and farms with less than $1 million in gross annual revenue, and it will also look at the dollar amount of those small business loans, recognizing that a lot of the smallest businesses, startups, micro enterprises need smaller loan sizes, and more established businesses might have need for larger loan sizes. The lending test will also give consideration to innovative or flexible lending practices. So that can be things like the special purpose credit programs that I mentioned earlier, but generally giving consideration to any loan products that are designed to meet the unique needs of low and moderate income consumers. So that was the lending test. Next up, the service test. Again, all three major types of entities receive this test: banks, credit unions, mortgage companies. And the service test looks at the financial institution's responsiveness and effectiveness of their service delivery channels. In short, how are you reaching your customers, and how effective are those at reaching the low and moderate income consumers in your assessment area? So the most obvious form of this is the branch network. So this test will look at how for the institutions that operate via branches, how their branches are distributed across their assessment area, and any record of opening or closing branches during the exam cycle. But there are also other ways that financial institutions reach their consumers. So this test will also look at the ATM network, especially the availability of fee-free ATMs within the financial institution's ATM network, and whether they offer phone or online banking, bank by mail, bank at work programs, other ways of reaching consumers where they are. And then finally, this test will also consider how financial institutions are marketing their products, particularly those that are tailored to unbanked or underbanked consumers. It's all well and good if you have a product that's designed to meet those consumers' needs, but if nobody knows about it, it's not going to be able to have the impact that we want to see in communities. Last up, the investment test. Only banks and credit unions receive this test since they're depositories. Since mortgage companies are non-depository, they don't get this test. And the investment test evaluates financial institutions' innovativeness, complexity, and responsiveness to community needs of their investments. This kind of captures a lot of the things that wouldn't be captured in the lending or service test. And the rule also specifically calls out efforts to prevent displacement due to gentrification pressures. And then finally, I also want to note that there can't be any overlap with the other tests, so activities that are considered under the investment test can't be double counted under the other two tests. So that is what financial institutions are evaluated on. Now I'm going to bring James back up to talk about where they're evaluated on it.
Thanks, Jane. All right, so as Jane mentioned, we're going to talk about where covered entities' activities are looked at. So I'll draw a quick distinction here at the beginning. There are assessment areas for banks and mortgage lenders, and assessment fields for credit unions. That distinction is made just because for credit unions, where they are assessed on their activity isn't necessarily geographically based, but I will use assessment areas kind of throughout this discussion to mean both. Assessment areas, as we've kind of said, are the defined areas or populations for which each covered entity's activities will be evaluated by IDFPR. And I'm going to start by just quickly running through the mortgage lender's assessment areas because that's the simplest. For every mortgage lender, their assessment area is the entire state of Illinois. They don't have to select sub-geographies, make any selection themselves. It's just throughout all of their activity within the state. The only kind of addendum or additional aspect that's added onto that is, as part of the examination process, IDFPR will review the geographies, if there are any, where mortgage lenders have full service offices within the state, and looking at their distribution across communities based on their economic status. Now, moving on to banks and credit unions, both entity types have to delineate their own assessment areas. And while the entities aren't evaluated based on their selection, IDFPR will review the selected areas to ensure that they meet the requirements from the final rules. Now, banks will select one or more geographic areas to act as their assessment area, with the primary requirements for that selection being they must consist of whole geographies made up of metropolitan statistical areas, metropolitan divisions, counties, cities, or towns. And second, they have to include where the bank has its main office, its branches, its deposit-taking remote service facilities, and the surrounding areas where it has originated or purchased a substantial portion of its loans. And that substantial portion, while it sounds a little vague, really what that means in the regulation is that if you were to remove that aspect of their lending, does their lending activity still reflect the overall lending of the institution? Now, for credit unions, their assessment fields are selected based on the institution's field of membership and must consist of members of their occupational and associational common bonds, members of other than community common bond members, and the geographies containing members and eligible members based on their community common bonds. So for those of you who are not quite as familiar with how credit unions are set up, really that just means anyone who's a member of that credit union or an eligible member of the credit union will make up their assessment field. Now, for both banks and credit unions, there are exemptions to these baseline requirements. Banks can select sub-geographies within the state of Illinois if they cannot be reasonably expected to serve the entire geography. And this is primarily for assessment areas that would otherwise be extremely large or of some unusual configuration. And credit unions can limit the size or scope of their assessment field based on factors that include the health of the financial institution, their ability to conduct marketing across geographies, and the locations of their offices and branches. The most limited that a credit union can make for their assessment field is limiting it to just their current members, so they can even exclude their potential members. Excuse me. Now, banks and credit unions are subject to two primary restrictions when it comes to their assessment fields and areas, and that selection is they must, and the first one is pretty obvious, they must not reflect illegal discrimination. The second being that they cannot arbitrarily exclude low and moderate income geographies or households. Now, I think it's pretty clear why assessment fields and areas are important to the covered entities. It's where their activities are going to be looked at by the state regulators. They are also really important for community-based organizations. You want to understand where the financial institutions that serve your community are being assessed to know whether or not you fall within that space, and the covered entity is going to be looking to engage with you for their CRA eligible activities. A lot of engagement for community-based organizations comes through submitting their comments to IDFPR. And this is how you're going to engage around the CRA. As part of the examination process, IDFPR will consider all written comments provided by the public that speak specifically to the institution's performance helping covered entities meet their community credit needs. That is to say, if you have a personal gripe with the covered entity, IDFPR does not need to know about that. Probably good to contact somebody at the bank, or the credit union, but these comments are exclusively for how they're meeting credit needs. Now, IDFPR will consider comments from the exam year as well as the 2 previous calendar years. As Jay mentioned earlier, IDFPR has posted a schedule of which institutions are coming up for their exams within the next quarter. The Illinois CRA Coalition webpage at the very top right now has links to those schedules. So if you're interested to see who's coming up, and she mentioned, I think we have 2 credit unions that are scheduled for the upcoming quarter, 2 more banks, and we just had 2 banks this quarter. We also, on the CRA webpage, have a link to where organizations can submit their comments. And I'll kind of jump back to that in a minute. You do not need to wait for an institution to appear on one of these lists to go submit your comments. As I said, Current year and 2 previous year's comments will be looked at. So if you have something you'd like to offer up to the bank or the credit union or the mortgage company, anytime you can go submit a comment. And something else I'd like to highlight around this, I think it's really easy to think about this feedback process as being a negative feedback, something that went wrong, an issue that you think the covered entity is not meeting within the communities they serve. But it is just as important, if you have a positive relationship with these covered entities, to go submit that comment and let IDFPR know what they're doing well. Let the institutions know what they're doing well. The institutions and the people who work there are part of your communities. They want this feedback. This is about working together and not simply seeking to punish a covered entity that isn't meeting the needs you see. And as I said, the positive comments will let IDFPR and the covered entities and other covered entities know what's working for communities and know what kind of programs are being successful. And this can help with the success of the Illinois CRA going forward. Now, kind of jumping into what submitting a comment looks like. So we've highlighted here on the IDFPR webpage, they have a consolidated space where you can find the forms needed to submit a comment. You can send a letter directly to the bank, and they are required to add that to their CRA files and include that in their assessments. But IDFPR has set up very easy to find and easy to use forms that make it clear what information they need from you and what information should be submitted. We have circled the link here. Once you get to this page, and it's clear, it's easy to find and easy to get here, but these fillable PDF forms are the comment forms. They're not quite labeled as such on that page, so we wanted to highlight them here. Additionally, I mentioned that on the Illinois CRA Coalition webpage, we've directed you to this page. We will be developing additional materials to help community-based organizations engage around and submit comments related to the CRA. And then here, a quick look at what the form looks like. Each covered entity type has their own form. While the content looks very similar, it's actually, I believe, identical, the important aspect is they go to different places at IDFPR. So each one very clearly marks, again, who it should be sent to at IDFPR when you want to submit your comments. Now, I'm going to jump into a little bit of considerations for community-based organizations and community members as they seek to engage with covered entities around CRA activities. Some of the things you want to think about before you approach a covered entity or walk in the door. The first one is institutional focus. You want to make sure that you have an alignment with the organization you're approaching. If you are an affordable housing nonprofit, the best partner for you is probably not a bank that focuses on small business lending. That's not their area where they do their work. You want to make sure you have institutional alignment. And while an issue we've kind of heard from some of our members over the years is they want to approach an entity and find out what kind of programs that entity wants to fund. Covered entities are looking to hear from the community-based organizations about what the community needs are. It's perfectly acceptable to approach and say, hey, what's your area of focus? Do you focus on affordable housing? Do you focus on small business lending? But you, as a community-based organization, covered entities want your expertise and your knowledge of the communities you serve. Next, knowing who to contact once you step in the door. So, again, a problem we've heard from a lot of people is from our membership across the state, is they don't know who to look for at a covered entity. The two primary groups or primary roles you're going to be looking for is a CRA officer or community development manager. So that's who you can step in the door and ask for. And I do want to ask and highlight to covered entities to make it really clear who those people are on your staff. Because again, we've gotten some feedback where a member of our network across the state will step in the door at a local bank, ask for the CRA officer, ask for the community development manager, and even the retail staff up front don't know who that person is and don't know where to direct them. So listing this on your website, making it really clear to all of your staff and all of your branches helps the community-based organizations connect when they're looking to do that. Next, determining the CRA eligibility of your activity. So Jane discussed some examples earlier, and we will be producing some resources kind of throughout the next year to help determine that. But that's going to be really important stepping in the door as well. You don't want to step in the door with something that a covered entity can't claim a CRA activity and it isn't eligible for them. Next, what do you have that tracks the impact at your organization for the activities you're currently conducting? If you can walk in the door with your pitch and say, this is the data we collect, these are the outcomes we see from our activities, that can even help you make that pitch for CRA eligibility. It might not be something the covered entity has funded before or partnered with before, but if you can say, we can prove to you that this meets the requirements under the CRA regulations, they might be willing to step out because, as Jane discussed, being innovative is something that the CRA examiners are looking for as well. And then communicating your organizational needs. Kind of the last thing on this page is come in the door with a specific ask. You don't want to walk in and say, what can you do for us? It's more, we need a grant to fund or start up this program. We're looking for an investment, for an expansion. We need a loan to fill a gap in a project that we have almost funded. If you walk in the door with a specific ask, it's much easier for the covered entity to help you get there as opposed to you approaching them with no specific needs. And now, we've talked about before that banks already had CRA obligations under the federal CRA, but credit unions, mortgage companies, newly covered entities. So there are going to be kind of some unique considerations when dealing with entities of that type, partially because they are just learning the ropes of this space themselves right now. Because banks and credit unions and mortgage companies have not been subject to the CRA obligations, their inclusion provides an opportunity to build new partnerships around CRA qualifying activities. And so these are going to be really kind of fertile ground to approach and start new projects and gain assistance with your initiatives. And we think their inclusion is really important, given that the CRA was passed to address the consequences of redlining. And research by the CFPB shows that between 60 and 70% of mortgages are originated by residential mortgage brokers and credit unions. So inclusion here is important for that. Lastly, something that plays a big role here is you want to understand that these organizations are operating at least a little bit differently in the case of credit unions and largely differently in the case of mortgage companies than the banks that were previously covered. So you need to understand the services and products that they are offering, as well as what their presence looks like in your community, whether that's they actually maintain physical offices or they are conducting their business virtually. Now, I'm going to pass things back to Jane so she can discuss a little bit more about what future CRA engagement is going to look like.
All right. I'm a lot shorter than James. Maybe this is obvious by the fact that we brought you all here today and fed you breakfast, but we want the Illinois CRA to work. And we're here really to be a resource for that. The advocates, our coalition, really want this law to be implemented well and successfully so that it can have the positive impact in the community that we know that it has the potential to have. Also, as James mentioned, the covered entities, banks, credit unions, mortgage companies, are part of their communities. Banks already have some CRA partnerships in place. Credit unions and mortgage companies may also already have some partnerships in place unrelated to the CRA, but they're part of their communities, rooted there. Your staff are members of the community, so also wanted to acknowledge that and highlight that any benefit to communities can be sort of a rising tides lift all ships kind of moment. And finally, in terms of us being a resource for Illinois CRA implementation, if you are a state-chartered bank, state-chartered credit union, mortgage company who is looking for introductions or connections to nonprofits in your area that are doing community development work, reach out to us. We would be happy to make some connections. And if you are a nonprofit or a community-based organization looking for help kind of crafting your pitch before you approach a financial institution or identifying financial institutions that you should connect with, reach out to us. We would be happy to help with that as well. For other things that nonprofits can do kind of to get ready, get the wheels turning, thinking about how you might plug into the Illinois CRA, you can familiarize yourself with local lending data in your community. I am going to do a shameless plug for Woodstock's data portal. We've got brochures out on the front table. It's a really rich resource with lots of information across the whole state. You can slice and dice the data by different geographies and different data points that you're interested in. So, okay, shameless plug over. You can also make a plan for which Illinois CRA exams you might want to submit comments on, like James highlighted. So you can think about which institutions are in your community and keep an eye out for when their exams are coming up, but you can also be proactive with that comment process as well. And then finally, consider how your work contributes to community development, responsiveness to the financial service needs of low and moderate income communities in your area. Start thinking about how your work links into that. And then I'm going to pass it back to James and we're going to close out.
Yeah, so there's just one other aspect of the Illinois CRA that we want to discuss today before we kind of wrap things up and open it up for questions, and that is the disparity study. For anyone who is not familiar, last year Governor Pritzker signed into law legislation that requires the Commission on Equity and Inclusion to conduct publicly available studies that IDF-PR will be able to use in the exam process. The studies will look at geographies in Illinois and focus on 3 areas. The first is they're going to identify geographies in Illinois exhibiting disparities by protected class with respect to access to financial products and services and lending and investment. Second, it's going to seek to identify policies, procedures, patterns, and practices that may have disparate impacts or discriminatory effects. And last, it's going to seek to identify opportunities for establishing and growing banking development districts. And those banking development districts are a state program to encourage the establishment of bank branches in areas with under or unbanked populations. Now, the disparity studies conducted will be used by IDF-PR as part of the examination process, making Illinois the first state to include an explicit equity lens in their CRA exams. And then again, as both the Illinois and federal CRA were passed to address inequities created by redlining, this inclusion of the equity lens is important for ensuring that the Illinois CRA is implemented effectively. There's a lot we still don't know about exactly what the disparity study will look like, how it's going to be conducted or incorporated into the exam process, but we expect rulemaking to take place around the study sometime this year, and we'll be monitoring and engaging in that process as it takes place, so you can sign up to receive notifications from the Illinois CRA Coalition, or just keep checking our webpage and we'll have things posted on that as it happens. Now, I'm going to thank everybody for joining us today. I'm going to pass things over to Horacio to kind of wrap us up and lead the Q&A.
Okay. Thank you very much, Jane and James. It's a lot of information. For people that know the existing Community Reinvestment Act, it was a very deliberate decision to mimic the federal law so as not to create undue burden, particularly for those that already are covered by the federal law for the state chartered financial institutions. But for some of you, this is new. I wanted to provide a little bit of context while you guys think about what questions you want to ask our panelists. I think, Jane, are you going to be able to stay for a little bit longer?
Yeah.
Okay, Jane is on her way to Springfield. Immediately after this, she's going to be working on some equitable student lending and predatory small business issues, so we don't want to get in her way. These are important issues. First, to clarify, I wanted to make sure that people understood that in the definition of community development, when you're talking about a disaster area, Washington, D.C. does not count. So I just wanted to clarify that. In terms of a little bit of context of where this came from, just so folks understand the continuum and how we've been able to leverage this coalition and have this policy when maybe 5 years ago, WBEZ and I think it was City Bureau published a report that showed mortgage lending in the Chicago area. And it showed one white community area getting more mortgage lending than all black community areas combined in the city of Chicago. And the brilliance of journalism in creating a visualization of that data that many of us in the policy world have seen forever and were outraged by. But journalists' ability to create a visual that's really simple to understand created immediate outrage. And at the elected official level, there was a hue and cry saying, explain yourself, industry. The industry did not, for the most part, explain itself. There were attempts, even by older people here, to have the federal regulatory agencies explain how it is that this was allowed under fair lending and anti-redlining, while at the same time having these institutions receiving at least satisfactory, if not outstanding, CRA grades. And it was felt that in the absence of rational answers, that the federal system wasn't working in a manner that allows the law to achieve its stated goal. As such, both at the state level and then at the city level, things were done. At the city level, responsible banking ordinance was created called the Lending Equity Ordinance, and that's been in place now for, I think, 3 years, where financial institutions who want to do business with the city of Chicago submit information similar to almost a CRA exam. And then community organizations, including Chicago Neighborhood Housing Services and Woodstock Institute, have an audience with the City Council once a year to talk about the performance and comparative performance of the financial institutions that want to bank Chicago. So that's an additional incentive. At the state level, this was a natural part of the policy agenda of the Legislative Black Caucus, along with the Predatory Loan Prevention Act, which shut down predatory lenders in Illinois, except for pawn shops. We're calling that Bruno. We just don't talk about it. We're just very upset about that. But the idea there with regard to the state CRA was what James actually brought up when we were looking at the preponderance of mortgage originations in Illinois. Banks are becoming a smaller and smaller part of that. Mortgage companies really are the ones that are picking up the lion's share of lending, and even more so, the percentage of lending to low and moderate income and minority borrowers. Kind of doesn't really seem, I mean, they're doing a very good job in terms of outreach, et cetera, but some of the data shows higher closing costs, some other stuff that we want to know more about. So it just seemed like products require like regulation. So we found the right kind of fertile ground to be able to create a Community Reinvestment Act in the state of Illinois that then kind of levels the playing field between all of the different types of institutions that provide similar products. So here we are today. It's taken 3 years. We're still waiting for this disparity study, which will be, and I do want to emphasize this, the first of its kind in the country to connect race to community reinvestment. This isn't an issue that Chicago or Illinois is interested in. Almost every state in the union is watching how this works and how it's implemented. We have to get this right, because if it doesn't work, all the people that say, see, I told you, are going to have the justification not to replicate what we've done in Illinois, to increase the bar on consumer financial protection and say we don't need to do it elsewhere. And just with Woodstock Institute alone, we've had dozens of states reach out to us, asking us, tell us more about how you passed your Illinois CRA. Matter of fact, I'm on my way to DC in a couple of weeks to give a speech specifically on the Illinois CRA. So it's sometimes people that are from here, I've only been here 4 years, people, usually where you live, you kind of trash it and you work off the assumption that it's better somewhere else. There's a lot to be proud of with regard to what we've been able to achieve in consumer financial protection in Illinois. And it is becoming a model for other states in terms of picking up the ball, and even more so now with what's happening at the federal level. I think the final piece I would add before I take questions is that There's a bill currently going through Springfield to clarify some of the ramifications of non-compliance with the Illinois CRA. One of the ideas of the treasurer that's in this bill is the withdrawal of municipal funds from financial institutions that are not in compliance with the Illinois Community Reinvestment Act, which we very much appreciate the treasurer's advocacy in terms of creating some teeth above and beyond its ramifications in terms of mergers and any sort of applications and state certifications. One clarity there is that there are some localities in Illinois where there's just one tiny bank in town. And if you withdraw municipal funds, then all of a sudden that bank may not be in town anymore. So we wanted to make sure, and we negotiated with the Community Bankers Association of Illinois to be able to make sure that there wasn't a domino effect that actually created banking deserts as a result of those penalties. And then finally, there are resources both at your table as well in the back. There's a magazine, or a zine, as HAI likes to call it, that Housing Action Illinois put together that is a very simple and very well thought out tutorial. There, Vanna is showing you the zine. Please pick one up, mostly because we don't want them left over. But also, they're also quite informative, as well as a member list of the organizations of Housing Action Illinois. It's a statewide organization with hundreds of members focused on affordable housing for mortgage companies, credit unions, and financial institutions. You may want to pick that up because those may be partners you didn't know were in your community. So I've given you enough time to come up with brilliant questions, and I believe there's somebody with a microphone. Miano Miller, also in our policy shop at Woodstock Institute, is in the back with a microphone. So if you raise your hand or stand